Hi, welcome back. You're watching Midcap Radar. It's a big week for central banks with the Fed meet starting later tonight, and we have the Bank of Japan on the 19th of December. There's the Bank of England meeting on the 20th, of course, but all eyes will be on Jerome Powell. Will the US Fed raise rates, and what will be the future trajectory here on? Nick Parsons, the head of research and strategy at Thomas Lloyd Group, now joins in with more. Hi, Nick. Thanks very much for joining in. The rate hike by Fed is almost a given this time around. It would be an outlier, if it doesn't happen. But most interestingly, what happens from here on, given, of course, this whole combination of the global growth slowdown, you have the trade wars, etc. going on. Inflation is still a little bit mild. And, of course, the way the U.S. stock markets have fallen.
Well, good morning from London. You are absolutely right that this is going to be a very important decision tomorrow. By way of background, we can look at the history of the Fed policy rate since 1980. And since 1980, there have been 76 rate hikes over that period. But of those 76, only two have come when the S&P 500 has been down over the past 3 months, the past 6 months, and the past 12 months. And that's the situation we have today. So over the last 3, 6, and 12 months, the S&P is negative. And that's only happened on 2 occasions when the Federal Reserve has raised rates. So although you rightly say that the market is really considering a rate hike as a done deal, there is that worry in the back of traders' minds that, they might not just do this. And if they decided not to do this, then several things would happen. I'm not convinced that we would have a big rally in equities because market would say, what do they know that we don't? Because that's the way that markets work. We would have a sharp sell-off in the dollar. We'd have a big rally in precious metals, and we'd have a big rally in the bond market. So that's if you like, the nuclear option of the Fed not raising rates tomorrow. But if they do raise rates, which is, of course, is 78, 79% priced into the market at the moment, then all eyes will turn to the dot points and what are they signaling for next year. They were previously signaling 3 rate hikes, although the market never believed that. The market never priced more than 1 hike in. But the question now is whether they go 2, 1, or 0. Just how far do they scale back next year? That's really the big uncertainty.
Nick, I don't recall which meeting was this, but this is within the last 2 years, I think. There was an occasion when the market was expecting a hike and the Fed did not hike. Or maybe the hike was lesser than expected. I don't exactly recall. And the market reaction to that was a big sell-off.
Exactly.
Yes.
The big fear when you have an event like that is when the market is really caught wrong-footed. The first reaction is to say, what do they know that we don't?
Right.
And the answer generally is nothing.
Right.
The Fed is not particularly smarter than the market.
Yeah.
The market looks at exactly the same indicators as the Fed. In fact, the market often develops some of the indicators that the Fed subsequently watches.
Yes.
But that's the fear in traders' minds.
Right.
That if the Fed really dials the needle back and either says nothing for next year because we're done, or they don't even go tomorrow, then I think any rally in equity markets would be very, very short-lived because it would soon be replaced by fear. And the fear that the Fed might somehow know something that has thus far eluded the market.
Right. And market reactions are always strange. We've had quite a few of those strange ones here over the last 10 days with state elections and whatnot.
Indeed.
But you're essentially saying that, a hike is very much needed at this point, even from an equity market point of view, however strange that may sound.
I think what the best outcome for equities, and this doesn't mean that they're going to go up, It might just mean that they fall less than they otherwise would. But the best outcome for equities is if Mr. Powell and his colleagues can somehow contrive to deliver a dovish hike. That's to say, deliver an interest rate hike, but dial back the expectations for next year, make it clear you're data dependent, and that you stand ready at all times to do what is necessary to support the broader economy. Now, some analysts, of course, will then interpret that as being somehow a Fed put in the equity market.
Nick,
so that's really the challenge. Deliver the dovish hike tomorrow.
Briefly, markets sold off on Friday, the U.S. markets. They sold off last night. What's going on? I mean, some are saying, well, this is thinned out liquidity conditions, don't make too much of it, and things like that. Or this is a reaction to fears of a global slowdown. What's your view?
Well, I think, again, some context. Context is important here. Thus far, if the S&P were to close on December the 31st, where it is today, it would be the second worst December for 90 years. You have to go back to 1930-31 to find the last time that we fell 7% in December. I think what's going on here is just investors moving to the sidelines, getting out of the market because you can't cope with this volatility. When a market goes up 300, 400 points and then gives it back all in a space of a few hours, then that's a market that you can't buy. Equally, when a market falls 500 points and then continues to fall, it's a market you don't want to buy. So you either can't buy it or you don't want to buy it. And I think the safest place to be is on the sidelines watching it, because actually participating in this is catching out the smartest professionals, let alone the hordes of more passive, longer-term and retail investors. I've no doubt that your viewers are very concerned by the volatility that they're seeing in the markets. They should know that the professionals are no less concerned because there are such a myriad of explanations, none of which is, on its own is entirely convincing, but all of which point to a stock market that's more likely to be moving lower rather than higher in the near term.
Nick, thanks so much. It's always a pleasure speaking with you, and thanks very much for adding that bit of clarity. So for the moment, stay on the sidelines, and the challenge for the Fed, of course, is a dovish rate hike. On that note, let's take a very quick break. Up next, Marico aims to achieve 10,000 crore rupee top line by 2022. That's an exclusive conversation lined up next. Stay tuned.